We're buying at 27 cents on the dollar after repair value. There is no downside, right? The only problem that I could see is if we actually got into a world war. Like really truly, if rates go down, we win. If rates go up, we win, right? Because we're doing this at condo quality, we could, at the very worst case scenario, just rent them and we would make gobs of money as monthly cash flow because our basis is so low, right? I know that everybody is worried about cap rates and oh my god, they're praying for cap rate compression. Oh, the rates went down. None of those are our problems, right? We hold these assets for 12 months. I could hold my breath for 12 months and get through that problem.
Quick favor before we jump in. It always surprised me that a large percentage of people who listen to this show regularly haven't yet subscribed. If you're a commercial real estate operator, investor, or builder who values conversations like this around deals, capital, and technology, please take 2 seconds and hit subscribe. It's a simple, free way to support the show. My commitment to you is that my team and I will continue bringing you higher level operators, stronger conversations, and real execution level insights every single week. Thank you. I truly appreciate it. Welcome back to the AI Edge podcast. I'm Luis Fernandez, co-founder of Edge Partners AI. This show is for operators, founders, investors, and real estate leaders who want to scale with better systems, better decisions, and better execution. We'll keep it practical, we'll keep it real, and we focus on what actually moves the needle. Today, we're talking about real solutions to the housing affordability crisis, not policy, not headlines, real executable model. My guest is John Laine, founder of Starter Home Fund. He's built a system that turns distressed multifamily into starter home ownership while targeting strong investor returns. This is compassionate capitalism applied as a operating playbook. John, welcome to the AI Edge podcast. I'm glad you're here.
Lewis, that's like the greatest intro ever. Thank you so much. Thank you for making time. I'm kind of new at this whole podcast thing, so I appreciate you reaching out and like when we were like first talking back and forth, I'm like, I don't know that much about AI. I don't know how I can be of service, but I'm willing to try and help in any way I can.
Fantastic. This is not a tech program at all. This is all about you. This is conversational. We want to learn more about your story and what you are building and what you're developing. So you got a powerful story, John. Very, very different model for people meeting you for the very first time. Give us a quick version, who you are and what you're building and what problems are you here to solve?
Woo, those are some big questions. Okay, so where I'm going to give you like the capsulated version. John Laine, founder, Fund. We started this idea of compassionate capitalism more than 25 years ago. I ended up losing my house in a foreclosure. I ended up with a pretty significant medical issue. And as want in America, if you have medical problems, guess what? You also have financial problems. I lost my house in the foreclosure in 2001. I got back, I got it. I professionally started real estate investing in 2001. Built a fairly large portfolio between 2001, 2009. They had 77 million in assets. This is pre-syndication world, so these were actually my assets. And then I lost everything, as happened in that era. I went from 77 million in assets to $5 million in debt in 9 months. Yeah, and so like I took a long break in real estate. I didn't really do anything for about a dozen years. Really started about 10 I took 10 solid years off and then slowly kind of trickled my way back into real estate. About 3 years ago, we started this idea of condo conversions, specifically working with nonprofit housing providers, buying their old assets at deep discounts and then renovating them to quality standard condos and selling them to first time home buyers. So we've been doing that for about 3 years. We have 56 doors in development now. We've created 6 homeowners. That's not a big number yet, but our goal is to get to eventually 10,000 homeowners. And so first couple of years were a little bit of trial and error. Now with Starter Home, we've really systemized everything. We've got 10 assets that we're going to be buying this year. We have 3 in escrow. Our goal is to make 1,000 homeowners in the next 3 years, and I'm like, we have systems in place to do that now. So that's the short answer.
I love it. You call it compassion capitalism. A lot of people hear that and think philosophy. So I want to make this episode about structure, execution, and scale. So, what was the moment where housing affordability stopped being an interest and became a mission for you?
So I'm going to point to these kids right here, right? This is taken 10 years ago. They're now all college educated in their mid to late 20s, all have really like smart children. These are my niece and nephews. And they, at one time or another, had to move back in with their mom and dad. Right. I mean, and Portland is an expensive city, right? Median home price in Portland is about 550, right? Rents are in excess of $2,000. The average median rent in Portland is like 1,800 bucks. A college kid cannot afford to live by themselves in Portland. It just doesn't happen. It cannot happen. So I started seeing people I love being deeply impacted by this affordability problem. I've done well over, I'm tipping toward $200 million in closed deals. Like I've been in this business for almost 40 years. I start watching these kids that I love suffer, and the light bulb just kind of came on. I know how to solve this problem.
Incredible. You've done a lot in real estate. What did you learn earlier in your career that directly shaped how you built Starter Home?
When I went through foreclosure, that was an incredibly intensely painful situation. And then, so as a result of my illness, I ended up helping a lot of other people who were in foreclosure keep their home. That's where that nexus, this genesis of compassionate capitalism started. And I guess I helped somewhere north, myself and a team, right? I always like, it was a big team. There's a lot of people doing this, but about 300 families saved from foreclosure in that really hard time in like the 2002 to 2005 before the economy. Because remember, .com kind of killed the economy, and so yeah, we've helped a lot of people, and that's kind of where the genesis comes from.
And when you say compassionate capitalism, what does that mean in deal structure terms, not in values language?
God, this is great. So we are an impact fund, right? Fund is an impact investment. And what I mean by that is we partner with 24 different nonprofit housing providers, right? So that's we try to lead with values, not views, right? We can all have political views, right? We try to lead with values, right? And so our values are we like working with philanthropic organizations, we like working with nonprofit housing organizations. By the way, side note, 15,000 nonprofit housing providers own about $1 trillion worth of housing, right? They own 1 in 11 rental units in the US. Like it's a huge number. So we started working with the nonprofits. And then the other part of how this compassionate capitalism balances, when we're done with a transaction, we donate 25% of the profits to the organization we purchased the asset from. Yeah. So it's we're and our investors make a good return. Like I don't want to equate impact investing with less than normal returns. Our investors are making 15 or 18%, right? Annual average returns. So it is that we're giving 25% of the profits to the nonprofit, and our investors are making, in most cases, 18%. So, I mean, it is that balance of compassion and capitalism.
That's still a great return. How are you able to pull that off?
Deep, deep, deep discounts from the nonprofits. Here in Portland, our average apartment unit sale price is about 177,000. We're buying all three of the assets that we're getting right now are at $75,000 a door. We're buying about $100,000 discount off what is normally sold. And the reason is that most of these nonprofit owners, two things. One, their NOI, right? We're all real estate guys, creative real estate guys. So the NOI is kind of the driving force because they're nonprofit, the rents are low because they're nonprofit, there's really almost no NOI, right? Operational cost is often negative NOI. So we buy these properties. And the third part of that is that there's often 20, 30 years of deferred maintenance. And so these properties are pretty much on their last leg. And when we buy them, they don't have much operational value. So that's how we're able to do. We're walking into, let's say, a 12 unit operationally. If it was a normal class B apartment building, it would sell for 3 million. We're buying that same building, 30 years of deferred maintenance for $1 million. And there's a $2 million delta in that.
Incredible. What do most people get wrong about impact models?
Most people, I would say the vast majority, think that when you say impact investing, they immediately think of reduced returns, right? If you're doing good and you've got this philanthropic 25% to the most people think that directly impacts the return. And we've proven this for 3 solid years. Our returns are great. Like our returns are just on par with every other syndication operator out there.
Where do you think the traditional affordable housing approach breaks down?
That is an hour-long conversation by itself. Five major points why. Okay, so let's start with there's roughly 7 million missing homes in America. Remember 2008, all the developers, including myself, closed shop. So you got this 7 million assets missing. There are five primary reasons. Number one, political will. There is no real organized institutional at the federal level political will to solve this problem, right? Number two, you got land issues, right? We've been building the same exact footprint for 75 years. Post World War II, we've been building 5,000 square foot lot, 2,000 square foot house, 10,000 homes make a city. And we've been doing this all elongated, right? Our land use policy, we need to be able to put 3 homes on a 1,000 square foot lot. We need to build up, not out. Like the policies by themselves are just antiquated. We're never going to be able to outbill the problem. So that's the second. Like there's literally five. Do you want me to go into all of them?
Let's do it.
All right. So the third is the aging demographic of skilled labor. An important policy note. This statistic always sticks in my head. 55% of all people in the trades, whether it's electricians, plumbers, right? 55% are over the age of 45. They're gray hair like us, right? So they're all heading toward retirement. They're all exiting the trade. Meanwhile, you only have 9% of the people in trades between 18 and 25. So there's no one replacing them. So you've got this super aging population that charge premium prices, $250 an hour for a plumber. So that's the third part of this is the lack of skilled labor. The
My
fourth, what's that?
cousin owns a carpentry business, and
Yeah,
he said exactly what he can't find a young guy who wants to swing a hammer, that wants to swing a hammer. They're not interested. They
they're
want
not.
to be YouTubers.
Yeah, yeah, truly. I mean, the guys swinging a hammer makes $75 an hour. A nursing assistant makes $15 an hour. Like caring for a human, my wife's a teacher, right? Caring for people makes substantially less than swinging a hand. And I love the trades, right?
Yep.
I couldn't
Sure. Sure.
operate without tradespeople, but they're all very expensive now.
Yeah.
I mean, there's 5 major issues that are so the other is NIMBYism, that's a whole thing.
What's the number four?
Political will, age, cost of materials, right? When I was doing, I used to do a lot of flipping, somewhere north of 800 homes. You could completely reno a house for $15,000. We're paying 60 for the exact same work now, right? So, I mean, you're talking a 4x price increase in 15 years, right? Oh, and let's talk tariffs, a tariff war, and mass deportation. That's where I go with no political will, right? These issues have consequences downstream that make the housing world very difficult to navigate. Yeah, so those are the big ones.
Do you have the five? Did you say
Well,
five?
yeah, NIMBYism is its own thing. Like you're going to be, if I have a McMansion, right? I'm a typical Portlander, right? I have a 1927 built home, 4 bedroom, 2 bath on a 7,000 square foot lot in Ladd's Addition. My house is worth $1 million. Right? I do not want somebody throwing up a sixplex next door to me, right? That's just, I mean, sadly, that is a supply and demand issue. It is core to American values to have like, this is mine, right? And so, I mean, I don't like the NIMBYism issue, but I do understand it. There's that both sides of that argument have very valid points. And I don't think you're going to solve that one because the guy who already owns $1 million house generally, not always, but generally couldn't give a shit less about the guy who's trying to get their first house. Like that's where that whole compassionate capitalism we go back to. It feels very yin and yang, but they are intrinsically tied to each other. And so, yeah, those are the big 5 reasons why we're never, ever going to get out of the build more doesn't work, lower interest rates won't work. Like, there's so many complex issues that intertwine that we're never going to outbuild. And even if we got back down to 2% interest rates, that's only going to jack up the prices. So, like, all of these mechanical issues work against each other.
Amazing. What do you believe is the real root cause? Is it supply, capital structure, down payments, or system incentives?
So let's go to you want like the global answer or the individual answer because that question can be answered 2 different ways. So globally, dear God, we need more buildings, right? We need the right type of buildings. We don't need 4 bedroom units anymore. We need 1 and 2 bedroom units. We need a mass amount of, in a perfect world, I think we should legislate that we need fourplexes, 2 bed, 1 bath, fourplexes, all scattered across the country, because that's the easiest, fastest way for homeownership, right? I think everybody is so fixated on the white picket fence, 3 bed, 2 bath, Rambler Ranch in the suburbs. That doesn't exist. BlackRock bought them all. Here's another interesting stat. Last year it was 35%. This year it's gone down. 29% of all homes in America are paid for in cash. 29%, 1 out of 3 homes are paid for fully in cash. That's investors like you. That's investors like me. That's investors like BlackRock. That's Warren Buffett's famous quote. If he could buy 100,000 single family res, he would do that. Well, he did. He's the one who's behind Berkshire Hathaway real estate, right? So single the single family res picket fence just those are all owned by corporations now. They're not owned by single mom and pop owners.
Talk, let's go right deep into the operator mode, John. So, walk me through the model like I'm a sponsor who wants to understand the machine. Ready? So, step one, how are you sourcing deals? What qualifies a property for the model?
Okay, so back up. How are we sourcing deals? We have 24 nonprofits that we work with. So they are literally sending deals our way. We have a pipeline of 10 buildings we're buying this year. Like where most operators are always looking for deal flow, they're trying to find their next deal. We have an overabundant supply of deals being handed to us. That I think is an extremely important advantage because I don't have to we turn down 3 deals a week. I mean, they're so let's talk about this for a second. Compassion, right? This is $1 trillion worth of properties. One in like 5 5.2 million apartment units, right? That's the nonprofit side. This is the capital side, right? These two guys don't talk to each other, right? Nobody I talk to knows about how the nonprofit world works. And they just know that it's an institutional and Portland Housing Authority or Chicago Housing Authority. These are just like terms they hear about, but they don't know that there's a system to work within that process. So we have just enormous deal flow, way, 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 way more deals than we can actually do.
What qualifies a property for the model?
So we're very specific buy box, 4 to 24 units, right? Keep them small, keep them boutique, turn the transactions quick. Our average transactions 12 to 24 months, right? Really, really fast. Um, they have to be uniform, right? Like they're very cookie cutter. That's why we like the apartments. We like the old vintage apartments because they're all cookie cutter. Generally speaking, within 10-minute walk to a grocery store and a 5-minute walk to a bus station, right? A major transit line. So we're really particular on helping our residents not be car dependent. So we buy exclusively in urban core on transit lines next to a grocery store.
So, we're still talking operator mode. Step two, what does execution look like?
Construction management. We have various tools and softwares that we use for, I mean, it started out as an Excel spreadsheet, then it went to a Miro board, then it went to, now it's a Gantt chart, going into a sauna, right? As we grow this business, we grow our tools because, okay, so we're buying at 75,000 a door, we're putting 60 grand into each unit as reno, right? Roofs, flooring, all of it. So, from an operator's perspective, construction is our biggest risk, and we have to manage that carefully.
Nonprofit partner coordination and buyer qualification.
All right, so that is from an operations standpoint, that is outsourced. Again, it goes to these nonprofits that we work with. One has all the assets. One is, I'm going to give them a plug, Portland Housing Center, greatest partner we could ever hope for. They do all the buyer education, they do all the financial wisdom, education, certification. They get them mortgage ready, right? They come in, when they come to us, they've got a mortgage in hand, pre-approved, ready to go. And so these nonprofits, I mean, that's their whole business model is to help. Portland Housing Center has helped 10,000 families become homeowners over like 35 years. So, I mean, that's why it's important to understand this philanthropic side of it because we couldn't do that if we were just doing our own business.
Amazing. All right, let's go to step three. How do you keep mortgage payment parity with rent? What are the levers that make the math work?
Okay, gosh, I wish I could share screen. All right, so we're buying it for 75, 60 grand to operate into reno, about 40,000 into operations, right? So all in we're paying $175,000 a door and then we're selling them for between, call it 250 for easy math, right? If you break that apart, it's basically an 80-20 loan, right? And so we ask our buyers to get a first mortgage, and that takes care of all the operational expenses of the transaction. It pays back our investors, it gives money to the nonprofits. Like that piece is paramount. They get a first mortgage. We come in, that rent to mortgage parity. We come in and say, all right, because we're carrying this second mortgage, right? That used to be done all the time. It's ever since the 2009, you can't really do second mortgages anymore. But again, it goes back to nonprofits. Um, we use what's called a CDFI, Community Development Financial Institution. And so the CDFI manages and services that second mortgage so that we stay compliant with the law. Again, it goes back to these organizations are really well designed for managing the money of these families. So we get to mortgage rent parity because with the second mortgage, they're not being hit with PMI, right? I know of one instance where PMI, private mortgage insurance, they were charged $277 a month for PMI, right? So you get rid of PMI altogether. So that creates better debt to income ratio. That eliminates that lowers, because again, we're carrying 20%, that lowers the interest rate. Instead of it being a 6.5, now they're walking into a 5.5. That's another $150 savings. If you're if you're at a $2,000 a month rent, I can mathematically show you a $2,000 a month mortgage, principal, interest, taxes, insurance, and HOA. And it's just the way that we've financially engineered this transaction.
That's incredible. Let's go to step 4. What's the exit strategy? How do you create liquidity while preserving affordability?
They're condos. The liquidity is in its name, right? We're selling those units. When somebody buys 123 Elm Street, unit number one, that's a liquidity event, right? And that's why our transactions are 12 months, 15 months, 24 months, right? Because so it takes, let's say, 8 months to from the day we purchase to the day we condoize. That takes about 8 months, right? Little bit of reno, little bit of musical chairs with the residents who are in there, a little bit of finance. So let's say 8 months. The rest is all selling time. And so liquidity events literally happen on a weekly, monthly basis because we're delivering, the median home price is 550. We're delivering products at 175 to three and a quarter. We're $200,000 to $300,000 cheaper than what is available to buy.
So they're buying a condo when it comes right down to it.
Yeah, yep. These are condos. So, and I mean, I think my favorite project bought a sixplex. It's three different duplexes all on one lot. So, I mean, it very much looks like a house, right? And so they got the big yard, they got the big trees. Yeah. They are condos, but they're strategically purchased and created to look like a home, act like in all the ways.
What are the top 3 bottlenecks in this model?
Cash, time. We are trying to scale on a national basis, right? We've done this transaction 8 times in the last 3 years. We've got 9 units, building 9, 10, and 11 that are closing in March, right? It scales nationally. We're in 5 different cities now. Cash, we need investors. Cash, we need better loans, right? Most of our loans are at 12%. Yeah, I mean, it's heavy construction, right? So most of our loans are awful. We finally got a lender that we like, but cash from a operational standpoint, cash from a lending standpoint, and time, I'd like to clone myself about 18 different times. Yeah. It's from an operational standpoint, I'm working 15 hours a day. Yeah. It is like we're still in that startup phase where you're just going. But yeah, time is the other piece that, like, we've got partners now. We're starting to like delegate and take some of the workload off our shoulders and put them onto other people. So that is a solvable problem, but the last couple 6 months it's been cash and
What breaks if execution is sloppy?
it's always construction risk. We have one project, $2 million reno, bought it for 1.5, killer deal. $2 million of reno. It took 6 months to get compliance with the city to do. We had to do a seismic engineering for the roof, right? So we had to tie the parapets to the into the so that it doesn't fall, right? So that was a $500,000 roofing project. What breaks? It's always going to be a construction risk. Like I've been doing this business for almost 40 years. It's always construction risk. Yeah. And so that's why we built in systems. We could not control the city of Portland. We have a project up in Tacoma right now. That's a construction risk that I think we're mitigating, but it's always going to be that third unknown partner, which is often the city. And and I mean, I love Portland. I will fight to the death. Portland is a great city, but we tend to be a little slow and bureaucratic.
What part of the process is most underestimated by outside investors?
Deal flow. Like I love our deal flow. Like, and I'm not kidding when I have 100 friends out there who are all suffering to make their multifamily deals pencil. I have really exceptional friends who have stopped syndicating. They're done with multifamily because deal flow is the biggest problem. We, on the other hand, I mean, I'm not kidding when I say we say no. We have on consistent basis. They're great deals. We don't have the manpower, time, or money to do it. Like we get deals literally every single week that are good quality deals, but it's a time flow issue.
This is the part my audience is going to love because this is where you separate hype from real underwriting. What's a typical capital stack look like for you, John? Debt, equity, preferred, and any special structures?
Okay. So it goes back to our basis is we buy at so this portfolio of 10 that we're buying that at 27% of after repair value. A whole portfolio, right? It's there's 108 doors at $75,000 a door in Portland. A whole portfolio. And so it starts with operational uh I'm sorry, with the cost basis. So let's go with the capital stack. So we buy it at $75,000 a door. We throw in 60 in reno. We're getting now that we've kind of proven the model and the banks love us, we're getting 90%, 85% CLTV loans, right? One of the big kind of hallmark successes, our first transaction, campus. We bought that for $1.8 million. We put 600,000 into it. We just got it appraised at $4.5 million, right? Because I mean, that's the power of condo conversion, right? You don't have to wait a decade for those returns to come in, right? So we've proven out that the value is there, that we are creating generally a 2x return in 15 months. So, I mean, that's part of the cap stack. When we do a transaction, we're going to buy it at 75 a door. We're going to get an appraisal that shows after repair value at 300 a door, right? 4 times higher than we pay for it. So the capital stack looks very favorable to us, right? Now that we've proven this 8 different times, the banks love us because we've proven that a $60,000 reno can turn into a $300,000 unit. Yeah. So let's go back to the cap stack. We're paying our investors because we need, let's say, generally about $500,000, let's say $650,000 per building that we buy, right? Forecast is we need about $5.5 million this year for our 108 units. We're we pay our investors, everything in our business is fixed rate, right? Our contractors are fixed rate, our plumbers fixed rate, our electricals are fixed rate, our investors are a fixed rate return, right? You put in $250,000, you get 18% return annually, right? AAR. So we've kept everything at a fixed rate so that at the end of the profit, the nonprofit gets that 25% of net profit. Our cap stack is everything is fixed. We have a very finite, definable. We know on $1 million raise, we're going to pay our investors $180,000. It's a very
Incredible.
finite number.
When you're talking to investors, so what's the return profile and what's the risk profile that you want them to really understand?
Because we are a small company, I only want to deal with nice people.
Yeah.
Right? I have turned down investors. They had large piles of cash and they were not what I would consider compassionate, right? We have, let's say, we've raised about $9 million combined in the last couple of years. And I like my investors. They're nice people. I would go have coffee or a beer with them anytime. I don't want the guy who's only looking at making a buck. And there are lots of those people out there, right? And so I will screen our investors because if you're not, if you, I don't, I'm from Portland. I am a bleeding heart liberal. I know that. Everybody knows that. My business partner voted for the other guy, right? We are very much yin and yang, right? I've been a Republican half of my life, right? So you don't have to be left or right. This is not a blue state or a red state problem. This is an American problem, right? So your political ideology doesn't matter to me, but your moral compass does, right? And so that is my biggest issue with about a third of the investors out there that I interact with is that they're literally only looking for the next biggest buck. So that's our investor profile. We want nice people.
That's great. What are the top risk mitigations you built into this model before you ever scaled it?
Oh, we had to we had to make some pretty significant construction is always the biggest risk, goes back to that. We were surprised by a $150,000 window repair. We were surprised by a $180,000 plumbing repair. This is a business where if you can't see the future, it's very expensive. So like I talk about the plumbing because we had a contingency budget in that deal, right? We got a $2 million reno cost. I always build in a 15% contingency. So even though we had the problem, we also built in the solution, right? And so in both of those cases, the window and the plumbing on the same building, we were mitigated because I've been in this business a very long time and I know kind of shit can go bad. Yeah.
How do you think about downside protection?
I'm gonna be a little flippant on this answer. We're buying at 27 cents on the dollar after repair value. There is no downside, right? The only problem that I could see is if we actually got into a world war. Like really truly, if rates go down, we win. If rates go up, we win, right? Because we're doing this at condo quality, we could, at the very worst case scenario, just rent them. And we would make gobs of money as monthly cash flow because our basis is so low, right? I know that everybody is worried about cap rates and oh my God, they're praying for cap rate compression. Oh, the rates went down. None of those are our problems, right? We hold these assets for 12 months. I could hold my breath for 12 months and get through that problem. It's just, I mean, I'm not trying to be flippant. I'm really sincere. Other operators have real problems. 5-year holds, who knows what's going to happen from a political, from a financial, from a pandemic, right? 5 years, that's a long time. Our transactions, a year. We're doing our one of our transactions 366 days in and out.
So, what happens if there's a weak housing market? Nothing? Or what happens if the rates stay higher longer?
Okay, so let's unpack the weak housing market. There is no such thing. There hasn't been anything like that in 15 years. And the problems of '08 are systemically impossible to recreate. So I've been in this business long enough to know the past has we've fixed those problems as an institution, as a country. The 40% of all mortgages are below 5%, right? No one, that's the whole lock-in period. We're never going to have those systemic problems of 2008. It's impossible. It's frankly impossible because all everybody's got fixed rate mortgages.
John, let's talk a little bit about nonprofit bridge. All right. So, one thing I love about your story is that you're bridging two worlds that almost never collaborate well: capital and nonprofit housing providers. What role do nonprofit partners play in your model? And why is that partnership essential?
Okay, so I go to my little house again, right? Compassion on one side, $1 trillion, capital on the other. They never really talk to each other. Like, have you ever been to a nonprofit housing conference? They're fun. I'm telling you, the nonprofits actually they're a good time. Bridging that gap, right? Bringing left and right together, bringing those two sides together is essential. We are not going to there's I mean, it goes back to these 5 problems that we talked about earlier, right? It's categorically essential that these 2 sides talk to each other because we have the capital, right? We've got trillions of dollars chasing good deals. These guys have systemic problems, right? LIHTC, we haven't talked about LIHTC at all. We're losing 90,000 doors a year in the LIHTC program. 90,000, right? And so that's systemically there's not enough preservation dollars. You can build a new building pretty easily anywhere in the country. LIHTC new construction is easy. Those older buildings that are poorly maintained because there isn't a profit margin, right? There's no profit margin in LIHTC. So you're getting 20 and 30-year-old buildings with 30-year-old roofs, right? I mean, they're begging us. I turned down a building that we could have bought for $12,000 at 99 construction.
What?
1990 construction. We chose not to buy it because the renovation was so expensive, right? The LIHTC, nobody's talking about like LIHTC's great from the front end, but it's an absolute train wreck on the back. And that's why these organizations are selling their assets because this LIHTC is unsustainable as a 55-year model.
In your experience, what do nonprofits need the most? Is it speed of capital, better systems, or better operators?
No, there's great operators. No, I want to make sure that everybody understands. I love the nonprofits. There's brilliance in that community. Please don't take the fact it's a capital problem, right? It institutional. These guys are the best in the country at operating. I mean, most nonprofits own 2,500 to 25,000 doors. Like the Cree world would love to duplicate the nonprofit world for institutional knowledge. I mean, they're truly epic operators. It's a cash issue. Um, their 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 business model doesn't support long-term maintenance. That's pretty much the biggest issue.
What does a great nonprofit partner look like? And what does a hard partner look like?
You can answer the same question with the same answer. Reach. I love working with Reach. They are hands down my favorite nonprofit from the acquisition side. Reach CDC here in Portland. I think they are operationally kind of the best in the business. Like we work with several, and like from the education, financial education side, Portland Housing Center. They're all good, like really true. Habitat, oh my God, Habitat is doing some really, really innovative stuff. Dev Northwest, Community Land Trust, Proud Ground, Community Land Trust. Like these are really super innovative pieces. Look up what a ROC is, resident owned community, right? I mean, God, the innovation with inside the housing community is, we don't get that. On this side of the ledger, no, it's literally throw granite countertops and a new toilet and charge another $200. Like that's the innovation from the capitalist side. These guys, there's no innovation from this side. All the innovation is on this side from the compassionate side. They're brilliant operators. Yeah.
How do you align incentives today so that nobody's fighting each other?
So we build in what's called an affordability covenant. So all of our units that we sell, we build in owner occupancy requirements, right? They can't be turned back into apartments. Owner occupancy, one unit per building can be rented for a period of 180 days maximum. And then it needs to get sold to another owner occupant. So you build in these affordability covenants that help manage the transaction on as a whole. And then again, partner with PHC, they're going to do so we do 80% AMI, right? So we only work with buyers at that 80% AMI, low to median income or low to moderate income. And so those families are the ones that we really, really try to serve. And that goes back to operational partnerships with PHC.
Let's talk a little bit about AI. I know this was a little scary for you, right, John?
You haven't asked a single question about AI.
No, it's all about you and your business and
I thought this
nonprofit.
was gonna be something more like, yeah,
A little bit, a little bit. We dabble in it. So now I want to connect the dots back to the AI edge. If someone is not using AI today, every model that scales ends up needing systems. So if this goes national, what breaks first operational and what must become systematized?
from an AI perspective, we are definitely going national. What needs to be systematized? Our Gantt chart, right? Our Gantt chart, if we could systematize the flow of deal, escrow, post escrow, renovation, if you could systematize the entire, let's call it 600 action steps in that process, my God, that would be amazing. Put the piece of paper in the right file. That would be helpful, right? I mean, basic, where does the appraisal go? We got the appraisal from the lender. Where does it go? What file, right? Can we put the appraisal in the pitch deck and the data room and the for investors and in the file for long terms? Like, God, I would love to do like a system that would actually operationalize all the tedious paperwork management.
Amazing. Where do you see automation, workflows, and AI becoming necessary in underwriting, investor reporting? Just talked about that. Buyer qualification, document handling, just talked about that. And consumer communication, where do you see it?
So I'm old enough to I my first real estate transaction was with a fax machine, and that was pretty high tech. I was pretty amazed by that. I am an early adopter of like I worked at a web development company in the early or the mid 90s, right? I've always been an early adopter of tech. The biggest issue is connect because this is such a heavy paperwork business, right? If I fill out one form that I have to send to the appraiser, to the lender, to the broker, to the other broker, to the one piece of paper gets touched by 15 people, right? And every single system is antiquated to pick it up and hold it, right? I want a folder. This, right? It's all about folders, physical paper. It's so last century. We got to be able to have a systemized process. That's why I like our Gantt chart, right? It systemizes the process of where the piece of paper goes. But I would love to digitize the whole mess.
What In your philosophy on AI, not as a tool, but as leverage, meaning fewer escalations, fewer mistakes, fewer decisions, what's the biggest source of uncertainty in the world right now?
I I don't like AI bots, right? Like LinkedIn filled with AI bots. I don't know who I'm talking to. At least 10 out of 30 conversations I have to wonder in the back of my head, is this a person or is this a bot? So I don't like the mistrust it's building. I think that's a real red flag. There's a lot of mistrust with the tech, and yeah, I think it could be weaponized. Like philosophically, this is just you and I, right? I'm taking off my real estate investor hat and just you and I talking. I think it can easily be weaponized, and I'm seriously worried about that. I'm looking at drone usage in Ukraine and thinking that's a real problem. So that's where I worry.
Just for the record, John, that was me that originally reached out to you. It wasn't a bot.
Yeah, I know. I asked that question. I'm like, "Oh, is this a bot? Are you real?" Yeah. There's a couple of AI experts out there that who are literally using bots to reach
Yeah.
out.
Yeah.
Yeah.
If you could wave a magic wand and install one system across your whole organization, what would it do?
Paperwork management.
Yeah,
Yeah.
100%. That was
I mean,
that.
because really, truly, here's another interesting stat. For every one house sold, it creates 2.5 new jobs into the economy, right? Most of those jobs are paperwork related. The AI can solve the headache of where is that damn receipt, right? So little things. AI can solve those really important because that one piece of paper needs to travel to a dozen different people. That appraisal needs to travel to 30 people, right? I want our investors to see the appraisal when it comes out. I want our investors to see my phone's over there, but we'll take snapshots of the daily progress, right? Our contractor uses a program called Company Cam. So we get daily progress reports, videos. I want that just to mass exports to all our investors because it's credibility. When it comes down to it, we are in a business of credibility. And the more it takes a lot of courage for somebody to write $100,000 check, right? There has to be an enormous amount of confidence in the person, me, but more importantly, what happens if I got hit by a car, right? That confidence goes away. If you had systems like an AI tool that sent out, we do weekly updates, biweekly updates for our investors every other Monday. What happens if I get hit by a car? Right? We need a tool that would sustain the credibility if somebody got hurt or couldn't. My wife was in surgery, our last investor update. We had to postpone it. So I think there's some general distrust with AI, but there's some super optimism, right? If you could default to solving these credibility issues, I think you win. If you can solve the is that an AI or is that a person, right? Those are big problems to solve, I think.
That's fantastic. Let's talk about vision. Paint the picture. 5 to 10 years from now, what does winning look like?
10 years from now, a minimum of 10,000 new homeowners.
Yeah,
That's winning, right? 200 and 2.5 to $3 billion worth of new homes created. That is to 250,000 new jobs. Yeah, I mean, our vision is to change the US economy,
incredible.
right? Homeowners vote 3 times more than non-homeowners, right? We employ the largest home builders are the largest employer in the country. Like, if you're to look at, like, the ancillary add-ons, yeah, we changed the US economy, and by default, the world economy. 10,000 homes, that's the future.
What needs to be true for you to help 10,000 families? What scale inputs must be solved?
Investment. I don't know. Okay. God, what needs to be solved? God, that's like another hour-long conversation. What needs to be solved? We need to solve the bottleneck between the solution provider, starter home, the people with the problem, the nonprofits, and the people with the capital, right? We're this relatively small, relatively young business, right? Working in on two sides of $1 trillion issue, right? The people with the capital and the people with the problem. And so, what needs to be solved? We need to build a cohesive flywheel of investors, nonprofits, condos, homeowners, right? It's a four per flywheel.
What are you most excited about right now, John? And what are you most concerned about?
What am I most excited? I love going to escrow. These kids, these families, oh my God, it is the coolest. It is literally happy tears. Like the escrow title hands them, the escrow officer, title officer hands them the keys and the whole 9 yards, and they go with their big old sigh. It's the coolest thing in the world to know that you have fundamentally changed that person's entire life. Like, kids that are not born, grandchildren that are yet to be even thought of. Like the legacy of what I'm getting goosebumps just talking about this stuff.
Love it.
I love that. It makes me so happy to see these kids get the keys. Let me ask, are you a homeowner? Do you remember when you first got your keys?
It was exciting.
Right?
Yeah.
Every single new homeowner has this giant grin. They're like Jack and Diane, man. They're just like, it's the moment of their life. They changed the trajectory. They climbed from one step on the ladder to the next. And they know that their kids are gonna keep climbing. Like it is, oh my God, I cannot overstate how cool it is to watch a homeowner get the keys.
Love it. What are you most concerned about?
I don't want to answer that question. I am most concerned about our political climate.
Fair enough.
Yeah, I could elaborate on that, but I think mass deportation, labor, trade wars, cost of materials, like those suck. Like
Those are some big issues.
every single person I know in the housing world, those are so I mean, what am I most concerned about? I'm most concerned about those two.
All right. Rapid fire. Let's have a little bit of fun. You ready?
Have we met? I don't really do rapid fire.
I love it. I
All
love
right,
it.
keep going. All right,
All
let's
right.
see what I can do here.
Best deal lesson you learned the hard way.
Stay in your lane. Out of thousands of small single family res, bought a 13-story apartment building. Never do it again.
Most important number you track weekly.
How many owners we have. That is our North Star KPI.
The biggest myth in housing affordability.
You should absolutely not do it alone. There are help, there is solutions, there are institutions. Everybody wants to do it themselves, and I'm telling you, there are 15,000 nonprofit providers out there willing to help first-time home buyers.
One trait every operator must have to scale.
Communication. You better it's the number one lever. If you better be passionate about what you do, you better love it, but you better be able to communicate your passion to other people.
Last one, John. Your definition of real wealth.
I mentioned I had $77 million, right? I mentioned that I did 175 million in assets. Wealth is not a number. Wealth is that girl right there. Wealth is having toys on my countertop that I can play with. Health is financial security, but most importantly, wealth is health, right? If I'm not healthy, the amount of money I have doesn't do anything.
Amazing. John, this was strong. For anyone listening who wants to follow your work or potentially collaborate, where should they go and what kind of partnership opportunities are you most open to right now?
Where should they go? Starterhome.fund. That's our website. I am very easily accessible on LinkedIn. So John Laine /starterhome. Schedule time on my calendar. That's like the easiest way to do it. It goes back to the same three, right? The four nonprofits who have problematic assets, operators who want to roll this business model out in their city because we can't get to 10,000 homes individually. This is why I'm on the podcast. I want this knowledge out in the world. I'm not trying to greedily hold it together. Operators who have that same compassionate capitalism North Star, and then investors who want a good, solid return. Like those are the three pieces: nonprofits, operators, and investors.
Absolutely amazing. We'll link everything in the show notes. And for everyone listening, if you got value from this episode, do two things. First, follow John and track what he's building. This is one of the few models I've seen that combines mission and math in the real way. Second, subscribe to the AI Edge podcast and share this with one of the operators who cares about impact, but also respects structure and execution. John, we appreciate you. And for everybody listening, keep building, keep scaling, and keep your edge. And we'll see you on the next episode of the AI Edge podcast. Thank you, John.
Lewis, that was great. Thank you. That mission and math quote, that was brilliant. I really thank you. This was a lot of fun. I appreciate the time and the questions. Oh my God. Like those are really good. I had to think about questions. I really appreciate the whole thing.
I appreciate you, John. Thanks again.